Hello, everyone. Welcome to the 20th Annual BDC Roundtable and the Accounting and Valuation Breakout Session. My name is Dwayne Dupree. I just want to kick it off with having the panelists introduce themselves. Clay, if you don't mind.
Hi, everybody. Clay Chandler. I'm an audit and assurance partner by trade with Deloitte. Happy to be here and looking forward to the session.
Thanks. John Zappler from Valuation Research. I'm the Senior Managing Director in charge of our Portfolio Securities Valuation practice. I'm also the Chairman of the Board of VRC. I've been with VRC for 24 years. I've been in the valuation space, coming up on 30 now. I'm a 10-year veteran of this conference, a little bit more. I think it's about 12 or 13 years.
Thank you.
And that's it. Yep. And I've been working with BDCs since 2004.
Great.
Hi, everyone. I'm Jamie Eichen. I'm a partner at EY. I'm an audit partner serving BDCs, registered investment companies, private funds, and investment advisors. I've had about 25 years of experience in the asset management industry. I also spent 7 years at the SEC regulating BDCs, including 3.5 years as the chief accountant of the Division of Investment Management.
Hi, good afternoon, everyone. Patricia Luscombe. I'm managing director and co-head of the Valuations and Opinions Group at Lincoln. Been there about 15 years. And our group, we have a large practice valuing illiquid securities, both private credit, private equity, for a lot of BDCs, global asset managers, private credit funds, and PE.
Hi, everyone. Payam Siddhatpur. I'm a partner at Evershed Sutherland. I've been on the BDC team here for about 17 years. Pleased to see all of you, and welcome.
Thanks, everyone. So I just want to get started with sort of setting the market backdrop. Inflation has been the highest it's been since the 1980s. With that, the Fed has been going on an aggressive campaign to raise interest rates, which you put that in the backdrop of fears about economic recession, and then also the recent bank failures. I'm starting off really positive today, I can tell you. But with that, I want to see if, pass it to you, John, what impact has that had on sort of valuation, particularly with BDC assets?
BDC assets. I mean, clearly the inflation's, impacted, a lot of the performance of the businesses. Clearly on the cost side, if you're a consumer products company, clearly with transportation costs, input costs, wages has impacted everybody. If you're a service company as well, that's impacted. So the cost structure's clearly been impacted, across the board. Some positive. I'll throw out one positive other than all these negatives. I mean, if you're in a commodities product company or you're a metal processor, oil and gas is obviously done pretty well because they're able to, commodity prices gone up. Usually those companies, the way the contracts are written, you're able to pass the prices through, and then you have economies of scale with the fixed cost structure. So some of those companies have done pretty well if you're in that space. But most companies, it's been pretty negative. Initially, they've been able to pass pricing across, to the end market on the top line, so been able to hold margins for a while. Now you're starting to see some pressure on the demand side, not being able to push those costs through. You're seeing more risk around that. And then clearly, as you mentioned, with the Fed increasing rates, with the BDC space, it's a levered play. All these companies have a lot of interest or leverage on the structure, so interest costs have gone up 40 or 50%. Since the summertime. So clearly companies impacted between the cost structure issues and then obviously with the interest costs. So cash flow is clearly impacted, on the portcos. That's what a lot of them are, struggling with now going into, 2023 here.
Got it. And did you have any comments on like the fundamental sort of portfolio performance, Tricia?
Sure. Yeah, no, absolutely. And so at Lincoln, with all of our valuation activities, we actually have a proprietary database. Every quarter, we aggregate all the portfolio company valuations that we do, whether it's fundamentals, whether it's multiples, whether it's leverage levels, and we look at in aggregate how are private businesses performing in this market environment. And so interestingly enough, one of the key statistics we look at is year-over-year growth. We look at both revenues, we look at EBITDA. So on the revenue side of the equation, revenue growth has been about 80%, interesting, and we really attribute that to companies have done a really great job passing along price increases, and demand for a lot of goods and services have remained pretty strong. On the EBITDA side of the equation, year-over-year EBITDA growth has only been 60%. So what that's telling us is that there's been margin erosion. We estimate it's been about 2% margin erosion. Companies are having a harder time with, passing on labor, supply, chain issues, commodity prices. So what we're seeing is slowing earnings growth, but companies are still growing. The other area that we look at, particularly relevant to the BDCs, are defaults. And we look at defaults, we measure them by covenant breaches, and we are seeing an uptick in defaults. It's currently across our database about 4.5%. That's up from about 3% since the end of 2021, but it's nowhere near the 9% that we saw during the peak of COVID. So all in, businesses in general, hanging in there. Offsetting that, and John, you touched on that, and what we're really focused on right now is interest rates, both base rate increases, SOFR being about 5%. We've seen credit spreads widen for new originations over the course of 2022, about 100 basis points. So what we're really looking at, can companies still afford the leverage that they have on their balance sheets? And we're seeing, we haven't quite seen it roll through all the numbers yet, with trailing 12-month interest, but we do expect the number of companies that will have interest coverage or fixed charge coverage ratios to be less than 1, could be up to about 40% of the portfolio companies within our database. So we really believe that the financing costs are going to be very impactful to the liquidity of portfolio companies, and it's something we have our eyes on very closely.
So with that backdrop, are there any discernible trends for the fair value marks for private credit? Is that emerging? Any trends?
Yeah, I mean, clearly I could start out. Yeah, I mean, clearly there's downward pressure on the valuations, and as Tricia mentioned, as I touched on, companies are starting to have trouble now passing costs through, with the lower demand. Now we're seeing if inflation's come in, Fed's trying to do their best job to slow down, it's some of the growth to bring the inflation in, and we're starting to see transportation start to come in and commodity prices come in. So companies, it look like have a better backdrop going forward. But as Tricia just mentioned, the biggest risk we're looking at from the valuation side is the interest coverage ratio. Just a reminder, right? EBITDA is before interest. So I mean, we're clearly looking at those interest costs. They've gone up 40 or 50%, for most of these levered companies that were, for the deals that were done pre-June of 2022. So now we're starting to see, I think our threshold is interest coverage. Once it starts getting below 1.5 times, we're starting to, be pretty concerned. We're asking questions about what is revolver capacity? Is the sponsor going to step in? Now there's more talk about, the private, the BDCs, the private debt guys, picking some of the interests, on the existing deals. We're seeing more of that on the new deals as well. And clearly a lot more amendments. We're starting to see a lot more amendments in Q1, and we expect to see more of that going forward, especially if base rates, the Fed tells you, you have conflicts. It's interesting. The Fed's telling you they're going to keep rates up for higher and longer, but if you look at the forward curves, the SOFR curves dips down. It's telling you we're at a peak level, and you expect rates to come in. So there's some contradictions going forward, but I think clearly the pivotal times will be the next couple a couple quarters, the company's going to have to live with the high SOFR rates up around 5%, and then the inflationary pressures. So we expect to probably see a lot more amendments and defaults.
Gotcha. So are there any particular impacts for BDCs of the bank failures that you notice with regard to the BDCs itself or portfolio companies? Tricia?
Yeah, well, it was interesting because I'd say kind of when the whole news on SVB broke and kind of that Friday afternoon before the weekend, we had a lot of clients that we were emailing back and forth, any impact on your portfolio companies. And I would say those clients that probably had more earlier stage investments, maybe they, technology, software businesses that did have deposits at SVB, they were concerned. They were concerned, would they be able to make, payroll, the following week? And really what happened, as we all know, all of that kind of fell away on the Monday, once the Fed came in and, provided, stability to SVB. But I'd say what's happened, and we've seen it with BDCs, we kind of think of this as another feather in the cap for BDCs, for private credit, just because all of this bank turmoil. We saw it in the broadly syndicated loan market. Spreads were highly volatile right after SVB, and then you had Signature Bank. And so it only made private credit and that private credit was unfazed by this news, an even more attractive alternative to banks. And so we believe that trend, private credit taking share from the BSL market is something that's just going to continue. And kind of SVB and the other banks surrounding it were really just another feather in the cap for private credit and BDCs.
So, Clay and Jamie, I want to get you in here. With that backdrop, are there any disclosures that people should be thinking about in terms of their financial statements or their periodic filings or anything like that having to do with inflation, bank failures, interest rates, that sort of thing?
Yeah, so maybe I'll start with the bank failures. I think it starts with a careful evaluation as to the exposure. The BDCs that I've spoken with haven't had a ton of direct exposure, but it tends to fall more into the portfolio companies and evaluating whether, the investments that they're making have exposure and how that all trickles down. So to the extent that there's not any kind of material disclosure, I would say, there's a judgment as to whether you want to put anything in or whether you want to say, explicitly we haven't had significant exposure. As far as, trends and rates and how that's all moving, I think the street is covering pretty well everything that's going through with rate changes, rate increases and so forth, and how that impacts particular BDCs. So, you do see that in a lot of what I'll call the front part of the MD&A around how the changes in rates are impacting the business, the monitoring, and ultimately funneling that back down to valuations. Jamie, I don't know if you've got anything you want to.
Yeah, no, I agree with that. I mean, I think, with the bank failures, we saw more, my venture capital clients that use SVB, but from a BDC perspective, not really. I think from an inflation perspective, agree. I mean, it's not really running directly, it's going through the financials, obviously, based on the rates and the floating rates and so forth. But as far as MD&A, there might even be in the, the quantitative disclosures about market risk where you're kind of showing, okay, I have a, 50 basis point, 100 basis point movement in rates. What is that going to do to my interest income, interest expense, net income? So you kind of see it indirectly running through there, but not a lot in the core financial statements directly addressing it. I think the bank failures also made us all think more about credit risk and concentrations of credit risk. And, are you on the hook if you have, deposits in excess of FDIC limits and so forth? So more disclosures around that generally.
Great. I want to switch topics here for a minute. By the way, I would like audience participation to the extent that you guys want to. So please raise your hand if you have a question about something the panelists said. I'm happy to stop and run this microphone down to you. So switching topics for a moment, I want to go to the valuation rule. We talked about that a little bit earlier, Rule 2A5. Just for some background, the SEC passed Rule 285, which gives the board the ability to designate a valuation designee, which has to be the advisor, or if you're internally managed, it has to be an officer. But it gives you this ability, which in my opinion was largely consistent with what BDCs were doing before, right? The 40 Act suggests, the 40 Act states that a board has to determine the fair value when market quotations are unavailable, which suggests that the board is actually making marks and doing all the things that the valuation experts do. And they were never doing that. They always relied on experts, they relied on the advisors, and so this rule, in some regards, is a recognition of that fact. And so with that, I just want to get some audience participation here. How many folks, I know we saw earlier, but we keep getting different results. How many folks in the room has designated a valuation designee for their BDCs? Okay, see a ton of hands. All right, how many have not designated a valuation designee? Okay, that was closer than I thought. Payam, what are some of the benefits of designating a valuation designee?
Well, I don't want to imply that not having designated means that you're at a disadvantage, so I don't want to offend anybody who hasn't designated yet. But I guess the primary benefit in my mind is that it allows the board to kind of focus more on its oversight role, which really, when you think about a board of directors of a BDC, that is really their role, as opposed to getting into the weeds. Like Dwayne said, 40 Act requires, when there's not a market quote available, the board has to establish the fair value of that asset. And that's, as much in the weeds as you can get. It doesn't really get, more into the weeds than picking a fair value or assigning a fair value to a portfolio company. And so what 285 does, it basically allows the board to get out of that business, to establish a framework, and to rely on the experts to designate or to assign that fair value, and to effectively monitor and oversee that. So to my mind, it's a little bit more consistent with what a board is meant to do. I think it's an acknowledgement by the SEC passing 285 that that's what a board's role is intended to be. And if anything, if nothing else, it kind of gives the board more time to focus on other matters, kind of more strategic matters, more oversight role. And I think it was mentioned at the previous panel, just a very tangible benefit that might interest some directors. I see at least a couple in the room. Where a board package before may have been thousands of pages, it probably is going to decrease significantly, because I think most people are of the view that if you designate, you would not then continue to send all the same materials to the board, all the valuation reports and things of that nature. It'd be more summary in nature. So all of a sudden, a board package is significantly smaller, which again gives more time to the board to focus on other kind of more oversight, broad, big picture things. So I think that, to me, that's the biggest benefit.
I want to come back to that point, but before that, what would be some reasons that you wouldn't designate a valuation designee?
So we've talked to a lot of boards about this, and there's a few different things that come up. One is that, since forever, BDC boards have been assigning fair value to all the portfolio companies, and some directors actually did not want to change. They were more comfortable with kind of maintaining control over that process, which is interesting to me because, and maybe you guys have had a different experience, but in the 17 years I've been doing this, I really can't think of any instance where a board disagreed with the recommended value. Certainly they asked questions and such, but I can't remember an instance where a board said, no, I don't think it should be par, I think it should be 95% of par, or maybe a couple times, very, very rarely, but they just liked the control over it. So that was kind of one reluctance, but the other, practically speaking, a lot of BDCs are run by smaller fund managers, and they just don't have enough staff to designate that role to. And that really goes to one of the components of the rule, which is the need to segregate the folks who are in the portfolio management side of the house from the people who are on the valuation side. So sometimes it's just practically not possible for a smaller BDC shop.
So on that point, the rule wants segregation because they don't want any undue influence from the portfolio managers on the values. So with that question, I guess with that rule in mind, John, Tricia, what is the role of a portfolio manager in the valuation process, right? Because those are the people that did the analysis, they picked it, they obviously have a vested interest, but what has their role been in your experience, and maybe what should it be with this rule in mind?
Yeah, I mean, I guess we're talking about the deal people, clearly. I mean, you know, the rule, as Pi mentioned, it's clear there's separation of church and state just because of the independence and the bias issues on the valuation conclusions. But that doesn't mean, you know, they're not involved in the process at all. So clearly we're relying on the deal teams that collect the financial information, they talk to the sponsor, they're putting together the initial investment memorandums, they're probably doing monitoring slides on a monthly or quarterly basis. So they're the ones, you know, obviously clearly closest to the deals. So, you know, their quantitative and qualitative inputs, you know, important inputs for us in terms of the information that we need for the valuation, their interpretations of the financials. Sometimes we don't always get MD&As. You know, what's the outlook with the business? What's the sponsor think, especially if they're getting in a more stressed situation? Where's the sponsor stand, you know, in this? Where's the liquidity situation? So that, you know, the input from the deal team's important. You know, we don't need to ask them what they think in the value, but I mean, clearly they're part of the diligence process for us, an important part of it.
Right. Tricia, you have anything to
Yeah,
add?
well, I was just going to add what we've seen are, you know, really the valuation committees are combined of both, you know, plus, you know, risk management. And so recognizing it's ultimately, you know, that valuation designee, which is typically in the accounting or valuation area, to determine that fair value. But that's not to say that there can't, you know, portfolio managers can't have input, you know, into the fair value process. And so I think we've just seen a lot of valuation committees that are really, you know, comprised of folks internally from, you know, portfolio management, risk management, and then of course the finance and valuation team.
And just to add one thing too,
Yeah,
is
sure.
you know, the other important part of, you know, speaking with the deal teams, and Tricia and myself, you know, we collect VRC a lot of the data. It's not you know, the market data on the direct lending market in terms of spreads and where spreads are and what credit terms look like. You know, it's not an easily transparent market. So one of the other important functions, you know, speaking with the deal teams, is really understanding the, you know, the credit landscape as well. Where's pricing, especially when we talked about the banking crisis. And I think when we spoke to a lot of our clients in February, the markets were pretty competitive in the direct lending market, and there was pressure on spreads coming down. Clearly, the PE space wasn't doing as many platform deals, didn't have as much volume, so there was a lot of money still chasing a lot of credit deals. You started seeing pressure on the spreads. Silicon Valley Bank happened. You know, like Tricia noted, it was a positive for the direct lenders. You know, spreads started really coming back out. So we need to understand, like, what is the current state of the market, what your pipelines look like. You know, we could see like the historical deals that they've done, but it's a pretty important aspect for us and, you know, for the valuation also. You know, to speak with the deal guys, the guys that are out there, the guys out in the capital market side to understand, you know, what is the current state of the market, what does pricing look like, what's volumes look like, what do terms look like.
So, Payam, you mentioned earlier that there was this thought when the rule came out, or maybe one of the potential benefits is the board getting less information or more summary information, not less, but more summary information, not looking at specific names. I just want to poll the audience really quickly. You got 3 choices. So if you work with a board, has the board received essentially the same amount of information, a little bit less information, or drastically less information? So if your board is receiving the same amount of information, roughly, if you could raise your hand. Okay, a couple folks there. What about a little bit less information, but more or less the same? Okay, a couple more hands. And then drastically less information that are received. Okay, it's not scientific, but it looks like about a third each. So was that poll within your expectation, Payam? And what are boards doing? How have they handled the transition for those who have designated valuation designees?
Yeah, I mean, look, as you saw, I think it is a mix. It's interesting. I think that I'm not sure that there's any one right answer. So that's maybe the good news. But to me, if you send the entire package that you've been sending, there is at least an implied duty to review it. And it could be that the board says that, look, we still want to get it. We still want to review it, even though we're designating. So I think it really is a board-by-board discussion. If your board members say, look, we don't need to see all those detailed reports that the valuation experts put together, I wouldn't send it. Because again, if you send it, there's sort of an implied duty to look at it. maybe a middle ground that maybe you send the watch list names, full reports on those, or if there's been a material decline or a material change in evaluation quarter over quarter, maybe you send that. But I'm a little bit surprised, to be honest, by the poll. I would expect that at a minimum to see slightly less, but at the same time, if a board wants it, you ought to send it. So.
Well, one thing that I've also seen is that, you know, the board gets summary information, but if they want any detail on any names, you make that available, you know, upon request is something that other people have done. So Clay and Jamie, so with that, the board has had this changed relationship with the advisor and valuation. And one of the things that I've heard a board say is like, okay, we know that the advisor is doing this job, but also like our auditor is going to be doing spot checks on valuation, just kind of doing that. Has this rule caused any more reliance on you guys in that regard, or more questions just in general about what third-party sort of service providers are doing for the BDC? Has any change that you've noticed?
So I would say a couple things that I've noticed in the boardroom around 2A5. The discussion specific to that rule has been more around, well, what are others doing and how are we peering and benchmarking against others? So to Payam's point, right, I've got one audit committee chair who wants every single piece of paper, and when kind of the board, or when management started to pull away, she said, well, where is it? I want it back. Yeah. You know, so then, okay, now you've got a 1,000-page report to look at. From an auditing perspective, I would say the perspective around 2A5, right, we're looking at changes. We're looking at changes in the policies, evaluating the policies that have been revised, looking at how internal controls may have changed, particularly for listed BDCs where, you know, we're actually opining on the internal controls. We're looking to see how all of that filters through. But if you take a step back and look at the actual auditing of the valuations themselves, you mentioned at the earlier part of the session, right? Nothing really fundamentally has changed. We're still beating up the valuations. We're still going after, you know, and risk assessing, looking at the more subjective models and inputs and things along those lines. That element has not really changed. So again, with the boardroom thinking about how 2A5 is impacted, more dialogue, but as far as actual questions and the valuations, I would say it's been about consistent.
Okay.
Yeah, I agree with that. You know, one thing we've also, when thinking about the financial statements, just making sure your disclosures are in, you know, 2A5 parlance, right? You know, if you have the valuation designee, making sure that's in there as opposed to, you know, sometimes you might see some old language, but I think people, once they've adopted the rule, have gotten there. I think, you know, there's also the question, what's the SEC going to be looking at, right? Because the examiners said, we're going to focus on the adoption of new rules, so they're going to look for compliance with 2A5. I also think it's a good time. You know, you have 2A5, you've just, you know, installed new policies and procedures. A lot of them may be conforming to what you've already done. Sometimes it's more form over substance, but it's a good time to just take a look at your policies and procedures, make sure you're following them, because in my experience in being at the SEC, when you see valuation cases, and especially if you're dealing with unobservable inputs, it's hard for the SEC to say, you're wrong, unless there's, you know, some transaction or some, you know, observable input that you're clearly ignoring or contrary evidence that you're ignoring, right? So they either will get you on, you're not following your valuation policies and procedures, whether it's cited through exams or an enforcement investigation, or they're going to get you on, you ignored something observable that you should have seen. So I think, you know, having the new rule, knowing the examiners are going to be focused on valuation, they're going to be in your shops potentially looking at it, just go through your policies and procedures, make sure you're actually doing what you say you're doing.
So I want to ask an opinion question. I'll throw it out to the panel. They aren't prepared for this question because it just came to me. So again, some hot takes here. So the rule requires that you provide the board with certain information. You have to provide an annual report or quarterly report. What information, in your opinion, is the information that you would expect the board to have, and that's almost required in your mind that they need to do their board oversight job with this rule in mind? I'll give you a second because I totally sprung this on everybody. What do you think, Payam? I can see it working.
So what information they absolutely should get?
Yeah, in the board books.
I would say certainly anything relating to assets that are in distress, so non-accrual assets, and anything relating to a material change in your process. And Jamie raised this about the SEC. If they come in and they look at you, what are they going to look at? In the 17 years I've been doing this, I've never heard of the SEC questioning a particular valuation, a particular mark. We had one case a long time ago where we got a call from the SEC, and they said, hey, we have a call from an anonymous shareholder who's complaining about your client's mark on this one particular asset. And we were, of course, very concerned. It was a little mini exam. We sent them information. They met with the valuation team at the client, and we described the process. And during that interim, it was over several quarters. So they really dug in on this one particular name for one portfolio company. And at one point, the mark was, say, 70% of par, but then something drastic happened. And in the next quarter, it was going to be written completely to zero. So from 70 to zero. So we were panicked. Steve Bowman and I called the SEC before the 10Q was filed and said, hey, we need to tell you something really bad that happened with that mark we've been telling you about. We told you it was going to be marked around 70%, but it turns out it's going to be marked down to, and they cut us off and they said, we don't care. And we're like, are you sure? We're about to tell you it's going to, they're like, no, we don't need to know. It's fine. And so the point is, all they cared about was the process, right? So they were satisfied with the process, and so they just effectively lost interest. So anything changing in your process, that's got to go to your board so they understand. And hopefully nothing does change, but to me, that's the main thing.
And I might just layer onto that. I agree with all that, but also where you've got valuations that are involving more judgment, or that are close calls, if you will, or a change in model. And I think you alluded to the change in models. But if you're looking at something that management has to make a decision or the valuation firms are making a decision that could be challenged, that might be something that's good for the board to see. If you're looking at a straight DCF where you're looking at a plain vanilla type of discount factor, that's not exciting. That's not something that the board would necessarily need to see. And the other thing that I would add on, if you've got significant movers, ups or downs, or the top 5 up, top 5 down, things along those lines, that might be what I would call more along the lines of dashboarding. That might be more useful for the board as well. And I would put that in the must-have package.
Yeah, just to add. Go ahead.
Oh, I just had one more comment. I think also because of the market environment we're in right now, 22 and into 2023, highly volatile overall. And Cindy actually had mentioned it on the prior panel about, why aren't, private credit marks moving as much as we see for the public markets? And so I think it's very, incumbent, very important for the board to understand how the private markets are are vastly different than the public markets, because that could be an important question from the SEC. Why aren't these marks moving? And so I know for us, when every quarter or annually when we are in front of boards, we always want to educate them about the private credit market and how it is different, how it is a more stable asset class. It's really built more on fundamental company performance, as opposed to the day-to-day spread movements you may see in the broadly syndicated world. And so that whole education process and understanding from a board to get comfortable with kind of the whole book of business or the whole book of marks, I think is really important, particularly in the volatile markets we're in right now.
John, I think you...
Yeah, I mean, it's challenging from boards now, right? The new rules basically saying, hey, you can have help, you can designate, but you're responsible. And they're trying to interpret, what's that mean? If I'm responsible, I need to look at everything. So, Pi and Mike going back and forth with this, what do they really need? And we would expect less from the designee. So to me, what's important from the designee is the help. If you have a portfolio of 200 names, is give them a list of what are the watch list names. That's obviously where you're going to be at most risk. What has moved the most? That's what you're going to need to see. What has been in, any big changes in the process or methodologies? That's what the SEC is going to find, look at. And then going on with Tricia, the other important thing is like, where's the market? All the boards ask to come in, or us, myself, or Tricia, and say, hey, what's going on with the markets? And because they're going to look at public, what they could see, right? Public, equity valuations. They may see loan indexes moving around. They want to know why it's not moving, and it's our job to explain to them why. The big aspect is part of what we do is part fundamental, explain what the companies do. And then the market, and that's the other thing the designees can do. Sometimes I've seen they've put together, 100 names, just some statistics, and just flag a couple things where they've moved pretty materially. So you can kind of you can hone in the board members, like what are at risk. It might be like, okay, it's like 6 out of the 100 I really need to take a look at. Maybe I should take a look at those reports. And we've seen it go a couple different ways where some boards are just like, just give us the executive summaries. That's all we're sending them. It's like 1 page. And then and we're asked you if you need something else. We're asked for the bigger reports for those 6 or 7 names. Then we've had some boards. It's really the personality of the boards. You find out, who's more risk averse. Some they say I need to see everything, or a bifurcated package. We send people like, okay, 1 pages for all the 100 names, and then everything else is in the back. We clearly designate it. And hey, if you want to go back and look or ask anything at the board meetings, you can ask. But talk to the designee. They can kind of hone you in where the risks are.
Right, right. Yeah, and this is sort of a trick question. Yes, audience participation. Thank you.
All right.
Seems like the best session to ask this. In that board oversight role, you're looking at a credit that unfortunately went south. And as you evaluate the pro forma financials, as it was at a point in time, and then they continually didn't materialize. Continually. What's the filter that you put on? Most of the transactions, it is going to be a pro forma outlook because they're going to buy companies, expand. So where is that jumping off point of you bought the pro forma that never materialized for too long? Any advice on that?
Well, I think from a valuation perspective, my boss is in the audience, and he taught me early on, you can't pay interest with pro forma earnings. You need cash flow. And so I think that's what we're at the end of the day. You can pro forma all you like and be disappointed by that the actual is not moving into that pro forma or morphing into that pro forma. So at the end of the day, what's the liquidity position of the company? Can they still support the leverage profile? And so that's what we're focused on at the end of the day from a valuation perspective.
Listen, it's real quick. It's a judgment, clearly. But when you're talking about a timing, something's supposed to happen. I think we'd want to ask, like, well, when's it supposed to happen? And if they say next quarter, this has to happen. If it doesn't, it doesn't. Then I think then you got to question it, I think, at some point. Or if there's a story, it's like, hey, it's delayed because the CODs, they've told us it's in process, it's another 2 months. Okay, that's believable? Maybe we have a documentation of that. You can push that out. But if it gets to a point where it's like, doesn't make sense. I mean, it's really judgment. If it doesn't make sense, it doesn't make sense. Then you've really got to cut it off at some point.
Clay, I think you were going to.
Yeah, and I was going to say kind of along the same, right? You want to look at historical results to the extent that the historical results aren't mirroring up with the pro forma. You kind of have to take a healthy dose of skepticism and say, okay, is management really putting forward financial information that's real? And maybe the answer is you've got to factor that in and haircut it and say they miss every year. I'm just going to take what they give me and haircut it by 25%. And that's a judgment that you as management would need to make, putting it into the valuation and into the models.
And sometimes we run scenarios, if there's a downside, upside, we use some judgment there. If something's not believable, we'll start factoring in weightings or scenarios as well. But again, some judgment with the facts and circumstances when you start doing that.
It's just, I think it's an inherently uncertain area, right? And then you put into account a principles-based rule, which makes sense with some uncertainty, but you tell people, hey, you have to do it, and we're not going to tell you how to do it, but we're going to expect you to have done it right.
Document it. Just, clearly document it.
I play that trick on my kid a lot. Go clean your room. I'm not going to tell you how to do it, but make sure you do it right. Yeah, so keep you guessing. But this topic is fascinating to me, but I want to move on so we can, happy to answer questions at the end. But I want to move on to the SEC has made some recent statements, the chief accountant, about material errors and material weaknesses. And I just want to get into that a bit. So, Jamie, could you start us off with kind of talking about what the SEC has been saying? Is that a position change or not? Or people viewing it as a position change?
Yeah, sure.
It's kind of confusing when they say it because materiality is something that everybody, securities lawyers think about all the time. Is this material, is it not? So when someone comes out with some new view of materiality, it's like, was it not material the whole time, or what happened? So,
yeah, I mean, there's a speech at the SEC every couple of years. You'll see one of the staff give a speech on materiality, and over the last couple months, there was a speech by Paul Munter, who's the chief accountant of the commission, very focused on how do reasonable investors evaluate materiality. And the framework has not changed, and we'll talk about the framework in a little bit, which is if you have an error in financial statements, previously issued financial statements, or even current, you're going to look at SAB 99, which we'll get into. But one of the the focus areas that Paul Munter was talking about is, okay, you have an error in, he was talking about previously issued financial statements. He said, well, you could have a small error, but it could be qualitatively material, so just be aware of that. For example, if the error could impact compliance with debt covenants or compensation arrangements. I rarely have seen that happen, and I've done a ton of materiality evaluations, but you still have to think about it. I think where the SEC gets concerned, and I'll give you an example, is if you have a quantitatively large error that you discovered in a prior year financial statement, what is your threshold for restating? And a lot of times people say, okay, you know what, I have all these qualitative factors that are on my side, so I don't think I need to restate. And you really, they want to make sure you're doing an objective evaluation. And so one comment that the IM staff recently made at one of the expert panel meetings, which caused us all consternation, from an accounting perspective, is that they talked about a fact pattern. And it was on a RIC, it wasn't on a BDC. But it was a RIC, and they said, this RIC, the staff essentially forced a RIC to restate prior year financial statements because of an income statement geography issue. So there was a reclass that needed to be made between realized and unrealized. And normally, when you go through your qualitative analysis, you tick off the factors. Does it impact NAV? No. Does it impact total return? No. Does it impact fees? In this case, the RIC, there's no difference in fees, realized, unrealized. No. It didn't impact ratios. And we're all sitting there, why did they have to restate? And so then I actually talked to them afterwards because I was a little bit concerned, because it totally, flipped on its head how we evaluate materiality. And it sounded like, and I think this is a lesson for people to think about, the way that it was flagged is the registrant, and this is all from my understanding of the conversation, it was a large error, and in the current year filing, they basically corrected the prior year number to make it correct and do the reclass, and they called it out, which you're supposed to do. Anytime you change anything in a prior year financial, you have to call it out. So you had that, they called it out, and then I think either in the filing or in a verbal conversation, the registrant must have used the term material. So then the staff thought, okay, if they're going to say that, well, then they have to restate. And so, I think whenever we and the accounting firms go through these evaluations and we have clients that say, you know what, I made a mistake in prior year, I want to fix it. We always say, think long and hard before you think, you fix it. Like if it's immaterial and you've concluded immaterial, your auditors concluded immaterial, your audit committee concludes immaterial, don't touch it, because once you touch it, you have to disclose what you did, because you can't just change a prior year number, and that's going to be flagged, and people are going to say, oh, if you touched it, you must have thought it was material, which is, it's hard for us as accountants and lawyers, we want things to be right, but once you touch something, people start questioning you. And I'll also tell you that the SEC staff, every time you make a filing, now they're more, technologically efficient. And so they have search strings, and they're going to search the terms automatically for concerning, terms or phrases. And this is something that they're going to flag. And so and if you, if you create language to get around their search string, they could pick it up in a review, but you're going to get the question. Again, it doesn't mean you're doing anything inappropriate, and it could be immaterial. But our advice is always just don't touch it. If it's immaterial, just leave it alone.
So it's almost like a one-way ratchet. If it's quantitatively material, then kind of hard to get around. If it's qualitatively not material, if it's quantitatively immaterial, the qualitative factors could make it material. So all roads kind of lead to material.
And it's all facts and circumstances, right?
Yeah.
'Cause you could have a quantitative error that's high, and you can get there from qualitative factors. I just think if you're going to get there and you're going to say it's immaterial, then don't touch it.
Right.
Yeah.
So on that, Clay, how do you determine materiality, and how is that determined?
Sure. So, I think a lot of times when when you're evaluating materiality, as Jamie mentioned, it's a case-by-case scenario. You've got to look at the facts and circumstances related to the error that you found. In the RIC space, I think there's a little bit more granularity typically around defining a policy, although there's no actual requirement, I would say, to actually have a formal policy, but a lot of funds are saying, well, if it moves NAV by a penny, we're going to go ahead and reprocess and go through that process. On the BDC side, there's rumblings that one may have adopted a similar policy to what RICs are doing, but I think generally it's more of a case-by-case scenario. And I think you need to look at the facts and circumstances, right? So if you're a non-traded and you just brought in new money and you found an error that impacts the NAV that you brought things in and it moves your return by 1%, you might need to think about it. And then looking at the notion of a big R versus a little r. So if you're thinking little r, right, you found an error that relates to prior year that if you needed to fix it in the current year, it became material. That's something that you need to look at. So looking at financial statement line items, looking at NAV, looking at things in total, looking at the qualitative considerations. It's not a one-size-fits-all type of scenario.
Right. And on the topic of material weaknesses, so Jamie, could you talk a little bit about that and maybe give some examples or talk about what those look like in the context of a BDC or an investment company?
Yeah, sure. So one of the other comments that the staff has been making in industry meetings is there's an uptick in material weaknesses that they're observing in the investment company space. I think it's primarily in RICs, but there have been several in the BDC space. And for an investment company, not surprisingly, the material weaknesses we commonly would see would be in valuation, income recognition. Potentially there's been a couple of RICs with income taxes, even though you might be tax-free entities. They also have some corporate taxpayers. There was even one for BDC for Oregon offering on the reclass. And so it could be all different things. It could be, you don't have controls to ensure the accuracy and completeness of data. You're not getting information timely and providing it to your service providers. So they could happen. I think the key thing to remember is that you could have a material weakness even if you don't have a material error, and I think that gets very confusing to people. So if we're doing an audit and we see an audit difference and it's above our nominal amount and we have to post it to our summary of audit differences and you sign off on it on the rep letter because we all think it's immaterial, we still have to do we have to do an evaluation to see if a control deficiency caused that error, and if it did, we have to evaluate whether you have a material weakness or significant deficiency. And the material weakness evaluation is, you have a situation where it could have been material, not was it material, could it be material? And the two things, and we always tell our clients, when we're going through this and we're going through these challenging evaluations, help us help you. Because the two ways that you generally could get around a material weakness is either you have a compensating control that you could point to and you can show us it's designed precisely enough such that it would catch a material error, or you could say, look, whatever happened, it's ring-fenced, it could never be material because of the nature of the account or so forth. But the material weakness evaluation's tricky, and that's something that you'll always see in the staff speeches saying, hey, remember, you don't have to have a material error to have a material weakness. Now, if you have a big R restatement, you're probably gonna have a material weakness, but that's kind of how it works.
Okay. So, Clay, I want to go to what controls can be adopted to kind of prevent material errors, prevent material weaknesses? How do you stop them from happening on the front end?
So it's a fine balance in compensating controls and having an efficient control structure as well, right? Because I think a lot of folks are tending to try to streamline controls such that you don't have, 3 layers on top. But, going back to the question of, well, this control failed, we had an error, it wasn't material, but could it have been? Well, then you go back and you point to those compensating controls and say, well, I got this control over here that says, okay, now I don't have a material weakness. So I think thinking about your control structure and your control process, focusing on unusual transactions, that's where a lot of the material weaknesses and significant deficiencies tend to happen. So if you've got something that's outside of the normal course of business, make sure you've got some controls around it and you're looking at how those controls are functioning. A lot of that may just be levels of review and documentation of those reviews, but make sure that they're there because that's going to help to the extent something pops in one of those items. Also from a BDC perspective, make sure you've got tight controls around valuation. It probably sounds silly to say in this context, but that's where the judgments lie. Having controls over the documentation of folks reviewing the judgments and evaluating those judgments, making sure that they're not happening in a vacuum, that's incredibly important as well from a control perspective. So I think significant / unusual types of transactions, things outside of the normal course of business, and then valuation, if you focus there, in addition to broad financial reporting, you're probably in a decent spot. Not to say nothing will get through, but that would be a good starting point.
Great. So we have about 5 minutes left, and I have a bunch of topics that we could go to, but I want to pause for a second to see if anybody has any questions on anything that we've talked about so far or anything else. Okay, we'll move on. So Jamie, I want to go to the SEC recently adopted Rule 611. Could you tell us a little bit about that rule and what impact it could have on BDC formation transactions?
Yeah, sure. So we're seeing now, and it seems like every couple of years it becomes hot, BDCs are forming by acquiring assets of private funds, right? Because people want to start up with a portfolio of assets. So Rule 611 of SX addresses the situation when a BDC is forming and it's acquiring all or substantially all of the assets of a private fund, because the question becomes, okay, what type of private fund financial statements or financial information do I have to include in my registration statement such that it provides investors decision useful information? So if a BDC is going to acquire all or substantially all of the assets of a private fund in a formation transaction, the BDC would have to include 1 year of private fund financial statements. This is all per the rule. 1 year of private fund audited financial statements in the registration statement. The financials could comply with private fund GAAP, although you do need a full schedule of investments that complies with SEC regulation SX. So you need a 1212, Article 12 compliant SOI. Now, the question that comes up, and there are some transactions that I think from a plain read of SX 611, you don't think 611 covers, but the staff thinks it's broad. So if you have a BDC that acquires less than substantially all the assets of a private fund in a formation transaction, the staff has been requesting folks to provide what's called an audited special purpose schedule of investments. So you're only listing the investments that you're acquiring of that private fund. So if the private fund had 100 assets and you were acquiring 20, you'd have a schedule of investments that just has the 20 assets. So that's something that's a little bit novel, and it's caught, I think, some people by surprise, but it has been consistent with prior staff positions.
Okay. Just want to tick off of as many things that we can possibly get through. So, Clay, could you take us through the updates to disclosure requirements for senior securities table and the prospectuses?
Sure. So one of the topics that came up across a lot of our clients this last busy season was around the disclosure and opining, having the accounting firm opine on the senior securities table. So many BDCs will have the senior securities right in the financial highlights or in the notes to the financial statements. If you've got it there, you're covered because the auditor's opinion covers the full notes to the financial statements. For those that have maybe put it in the MD&A, You need to have a separate opinion from the accounting firm that covers the senior securities table, and really all it does is it says that the amounts and disclosures in that table have been subject to audited procedures or audit procedures, and it's a relatively clean and straightforward process. Some of our clients have also gone and had to do a sticker around the prospectus, so for 424B3 to effectively attach the senior securities table and the related opinion to that prospectus.
Okay, great. So last chance, any questions? We got a minute and a half. Yeah. Okay, I will let you guys have the minute and a half. Thank you all for participating in this evening's session, in this engaging session. We now have 15-minute networking break before the next round of breakout sessions begins at 3:45. Thank you all for attending.